QuickBooks Online 2025 Inventory Reports. Get ready and some coffee because we're learning how to save time with QuickBooks Online 2025. Here we are online in our browser searching for that QuickBooks Online test drive, the free sample company file available to everybody. Looking for the result that has Intuit.com in the URL because Intuit is the owner of QuickBooks. Choosing the United States version of the software, and then we have to verify that we're not a robot with the checkbox. Boom, not a robot. Going to the left and closing this out. I don't know why robots have problems with checking boxes. You'd think, that would be something they can do, but no, apparently not. They don't have that capacity. Let's go down to the reports on the left-hand side. And we're in the favorites. We're gonna go into the balance sheet, right click on that balance sheet, open in a new tab. We're gonna do this every time. Right click on the profit and loss, open that link in a new tab as well. Go to that middle tab and close up the hamburger. Let's change the range. We've been doing that 2-year time frame. 010124 tab, 123125 tab, selecting the drop down to see it in years. Run it so we can refresh it. 2024 and 25 are now side by side, repeating the process to the right tab, closing the hamburger again and changing the range. 010124 tab, 123125 tab, drop down, see it in years, run it to refresh it. So now we're going to be looking at other reports, remembering that other reports are typically going to give more information about one or multiple line items within these reports. This time looking at the inventory types of reports. And anytime we touch in on inventory, we have to remember that number one, inventory will not be in every business. So if you're in a service business, you don't have to deal with inventory. So as a bookkeeper, you want to say, where am I going to specialize? Do I want to deal with businesses that have inventory or not? If they don't have inventory, it might be a little bit easier for me to basically build a business where I automate everything, possibly just with the help and use of the bank feeds, because inventory is typically one of those things that throw a wrench into the system when we're trying to automate everything. If they do have inventory, then the question is, do I want to track the inventory physical unit wise within QuickBooks or do it outside of QuickBooks? If I do it outside of QuickBooks, we would typically be using some kind of periodic inventory system as opposed to within QuickBooks, where we're typically going to use a perpetual type of inventory system. So for example, if you have something like a website where you sell stuff, a Shopify store or Amazon, maybe you track the physical units within the Shopify store and Amazon and whatnot website and not in QuickBooks, because if you pull in all the data to QuickBooks, it might actually be more overwhelming than necessary. Possibly you just update QuickBooks with regards to inventory periodically, at least yearly, so that you're in compliance for tax preparation, where you do need to do a cost of goods sold calculation, including beginning and ending inventory if you're in the United States, or you can populate it more often than that, doing adjustments on a weekly basis, monthly basis, quarterly basis, or so on and so forth. Now we have whole other courses or sections on a Shopify store and what kind of stuff you might want to link to it or not link to it. That's another specialty area. If you sell stuff physically on ground, say at a cash register or something, you have a similar kind of question. Do I want to track the inventory physical units on an Excel spreadsheet and adjust them periodically and then do, once again, periodic adjustments into QuickBooks on a daily basis, weekly basis, monthly basis, quarterly basis, yearly basis? Or do I want to track the inventory within QuickBooks, which means that I have to make sure that I set up the items properly so that when I make the sales forms, it'll populate. So if I go to the first tab, you will recall if I hit the drop down that the forms we use to make sales are going to be the inventory, the invoice form. If it's increase in accounts receivable, you make a sale, you didn't get collect on it yet. Or if you collect at the same time, then we're going to be having the sales receipt. That would be like at a cash register type of situation. If I go into a sales receipt form, we'll see that down here, we've got the product or service. Now, if you're at a cash register, we would like to have the products and services set up already so that I can have someone that doesn't know anything about bookkeeping still populate it. You got some kid in there working the cash register. And most kids, I'm not going to call them stupid, but they're like distracted. Let's say the kids are distracted, like a teenager, distracted teenager. Okay, they're not stupid. They're not stupid. No, but they're usually not very focused. Although I think some of those people, they got a 19-year-old working at again the government Doge thing, and that guy seems like a maniac. He has a weird nickname apparently, but man, he seems like a smart person. So there are some focused team, but usually if they're going to be doing the receipts, I wasn't focused. Your mind's kind of wandering around. So you want them to be able to populate things. That means that you want to have the items set up so it's easy for them to populate that. And the items, if I close this out, are over here in the sales tab, and then they're in the products and services where we set up the items. If they are inventory items that we want to track within the system, we're going to need the cost of the item so that when we purchase it, it records not only the dollar amount, but the unit and the cost. And then when we sell it with an invoice or sales receipt, it records not only the sales price, but the cost of goods sold and reduction to inventory dollar amount, as well as unit decreases. So that's going to give us more information if we're doing this perpetual inventory system when we look at the inventory reports to mainly, if I go to the balance sheet, this inventory account. So we will only have an inventory account if we deal with inventory, and we'll only have physical unit accounts that are going to have the subledgers if we have a perpetual inventory system tracking the physical units within the system. So let's go back to the first tab. Let's go down to the reports on the left. Now, usually when I look for the inventory reports, I just type in here inventory, and you have the inventory valuation summary, most likely the one we're going to use the most, inventory valuation detail, and the inventory valuation worksheet. Let's see where they're located, however, just in terms of their groupings. Notice that the inventory is a little bit difficult to group because inventory has, like, where do you put it? It's an asset, but we don't have really a grouping here for just asset accounts. You would think it might be in the business overview area here, but it also has a sales component because we sell it to customers. So maybe you put it on some other account that deals with sales or customers. So you would think they might put it in the overview, but I don't think they put it in the overview. It's not going to be in who owes you typically, because that's going to deal with accounts receivable. And so they usually might owe you because you sold inventory. So you can see they might think that that would be a reasonable spot. Sales and customers. So this is the income statement account of revenue that we looked at before. And I believe they put them here, right? So here's where we have the inventory valuation detail, the inventory valuation summary report. So let's open those up. Let's right click and open a new tab, and then open this one, right click, open a link in a new tab. And then I think they also have the inventory valuation worksheet. Let's open up that one by doing it this way. Inventory. They also have the inventory valuation worksheet. Will they let me open that in a link in a new tab? No, I'll just open it here. So we'll open that one here. Okay, so let's go then to the most common usage, the inventory valuation summary. All right, I'm going to close up the ham boogie. We'll change and notice it's as of a point in time. So we can keep the range. That's going to be the current date that I ran the report for. Maybe I do it at the end of 12/31/25 just to have it at the same point, the end of the year. So I'll run it here. And then what do we have down below? We've got the list of inventory items that have inventory units within them as we track the inventory within the system. We've got the SKU number if we have a number for it, identifying it by not just by name, but by number, those inventory items. Then we have the quantity on hand. This should be the physical count that we have on hand, remembering that this physical count is being populated as we purchase and sell it when using a perpetual inventory system, which we would be using if we're tracking this report in the system, meaning when I buy inventory with a bill form, a check form, or an expense form, then that's going to be increasing the units of inventory as we pay for it. When we sell the inventory with an invoice form or sales receipt form, it's going to be decreasing the units of inventory automatically, even though we don't see the units of inventory or cost of goods sold, but rather just the sales price on the sales forms, sales receipts, and invoices. So that gives us our asset value. So we're talking about the value in terms of dollars here, and that gives us our average calculation in terms of the average cost. And that's just basically saying that if I took out the trusty calculator and we said that we have the 250 units divided by 25, that's going to give us an average cost of 10. Now, something we want to remember with these inventory tracking, it's more complicated than you would think at first to track the unit cost of inventory. Why? Because even if you're buying the same thing, like this pump, then it's possible that the price of the pump goes up over time. And let's say they're all the same thing, like they're all the same pumps. We just put them on a shelf and we're going to sell them. People just pick them. They don't always pick the latest one, although we try to make it so we put the latest or the oldest one on top so that they do buy the oldest one, but that might not always be the case because they're all the same. So then if that's the case, then the cost of the pumps might go up over time. If the cost of the pumps go up over time, when I sell the pump, we end up with a problem. Which pump did I sell? Did I sell the oldest pump that cost less because it was older and therefore inflation happened, so it was cheaper before? Did I sell the newer pump, which usually costs more if you're in an inflationary period, which we typically are as a default general? Or do I take some kind of average? Could I average them out? And those are the three flow assumptions that we could have. Now, typically, we don't have a last in, first out flow assumption. We don't assume that we sold the last one first. Usually, you might make that assumption, but usually people make that assumption for like taxes or something, or they're trying to manipulate the books because logically we would try to sell the oldest one first, generally. So the two flow assumptions that you would think about then are, do I want a first in, first out flow assumption, which usually means that I'm going to assume that I sold the older one, which is usually the cheaper one, or do I want to recalculate the average each time and use a weighted average method to calculate the cost of goods sold and reduction of inventory? Now, note that I believe the online system, although they give you this average calculation over here, are actually using a first in, first out type of calculation, which is quite common. So that means that you're actually going to have a layer of inventory if you bought inventory over time, even though it's the same pumps here that have different prices, and you're assuming that you sell the old one first is going to be the general idea. The old system, by the way, QuickBooks Desktop, I believe used the weighted average. Notice that could cause you a little bit of confusion if you're transferring from a prior accounting system like QuickBooks Desktop that used a different flow assumption, possibly weighted average, and you're transferring into QuickBooks Online, which uses a different flow assumption. Now, because that might not cause you a problem for if as you move in, but notice that like for taxes, for example, you usually have to choose a flow assumption or some type of accounting method and stick with it. We don't really like changing accounting methods. So in other words, usually the idea is you can use whatever accounting methods you want if they're within the range of methods that are acceptable. But what you can't typically do is switch back and forth between methods unless you have some rationale for doing that. So just be aware of that difference possibility in the flow assumptions. So this gives us the asset value then in dollar amount, and the asset value coming out to the 59625 should tie out to what's on the balance sheet, which is here at the inventory 59625. Noting that I always want to compare this to the accounts receivable because that's, I think, the baseline subsidiary ledger report that we typically think about. So the accounts receivable would only be there if you sell inventory or sell things or services or inventory on account, and you're going to collect on it later, so you have to track the accounts receivable. If I go into the inventory account, we have what we would call from a book standpoint the general ledger type of account, which QuickBooks calls a transaction report, breaking out the detail by date, giving us the actual forms that create the journal entries under a double entry accounting system, having at least 2 accounts that are impacted with every transaction. But we also want to see a subsidiary report. So I'm going to go back. So the subsidiary report for accounts receivable would break out the same information, not by date of transaction, but by who we owe the money to, by customer. So, and remember that the accounts receivable report actually forces the sub-report to be in balance, because it forces us every time we post something to accounts receivable to include a customer. With inventory, similar situation, except that QuickBooks does not force us every time we post something to the inventory account to record an inventory item, which means it's possible and quite likely, if you're not careful, to have the subsidiary report not match what's on the general report over here. That's a problem for inventory, so you want to be careful of that if you're using a perpetual inventory system. So in other words, if I go into inventory, I still have what we would call, from a book standpoint, the general ledger account, QuickBooks calling it a transaction report, recording the inventory items detailed by date, giving us the forms involved, meaning the forms that decrease inventory, invoices, and sales forces, receipts, the ones that increase inventory, check forms, and bill forms. And then if I go back, though, I also want to see the subsidiary ledger breaking out the inventory not by date of transaction, but by inventory item. So that's going to be the inventory valuation summary, which of course is going to be this report, giving us the inventory by item. Now note, we saw that some reports, like the sales subsidiary ledger reports, breaking out sales by customer or item, might differ sometimes because you're able to post something to sales without adding a customer or item as well. But the income statement reports, remember, that's not as big a problem, because the income statement reports will reset as they close out at the end of the period. Balance sheet reports will not. So if the inventory is off from the subledger, then you're going to have to fix it, right? It's not like it's going to reset at the end of the year. It's not like in January it's going to be okay now, because it's a balance sheet account. It's a permanent account. You're going to have to figure out what the difference is or make some kind of adjustment to get back in alignment. Now, also realize that this inventory report, although it's being tracked perpetually, over here the items are being tracked as we make transactions. It's not exactly going to be equivalent per se to what's physically in the inventory. So these are the units of inventory. That might not match what's physically in stock. Why? Well, mainly because you might have spoilage. You might have some kind of shrinkage, as we call it in quotes, which could be theft as well. And if you're in California, of course, theft is it's like almost legal here to steal stuff until they crack it down. Now, they're starting to crack down. We had fires over here. People are like, man, I don't know about all this, man. Maybe we should stop people from stealing stuff, and maybe we should have water in case of fire and stuff, and people that know how to have the capacity to hold a hose. It's crazy. People are waking up, man. I don't know if it's going to last, but in any case, so that's going to be, so that means that we might have to compare, obviously the physical count, we will have to compare that to what's in our books and make periodic adjustments to it possibly. And that's when we use this, possibly the physical inventory report. So if I run this physical inventory, what we would typically do is say, hey, I want you to count the inventory. And I might not even give them the report. I'm not going to tell them how many are in the count. What are they going to do if I tell them? They're not going to count it. They're just going to look at the number and say, well, there's 25. It's like, no, I want you to count it. I'm not going to tell you how many there are. And then they should count. And then I know they actually counted it, right? And then I can compare it to the 25. And if they say that there's only 23 and there should have been 25, then, you had someone probably stole something or something like that. And we got to crack down. We got to get the cameras out there. It doesn't matter if you have the cameras in California. You can watch them. They can wave to the camera. They can show you their ID card and their social security number, you still can't go after them or anything, apparently. If you do, they'll sue you. It's crazy. But I'm just kidding. Maybe that's a little too far. Anyway, so if there was a difference, then of course we'd have to go into the plus button over here, and we'd have to do an inventory quantity adjustment. So we've looked at this form in the past, but that would be the general process, right? We're gonna track the inventory perpetually, and it's going to be recorded perpetually, but we're still going to have the internal control of doing a physical count from time to time, which might reveal that there's been shrinkage, spoilage, theft, in which case we're going to have to trust our eyeballs and not the computer, right? Because that's what's physically there, and we'll have to make an adjustment writing down the inventory to the physical count. That's the general idea. Now, we also have this inventory valuation detail report. Oh man, what happened? Que paso? I closed it up. Let's go back in there. Let's go back in there and just take a quick look at this one before we wrap it up like a present. Inventory. We got to wrap it up fast before they steal it. Inventory valuation detail. And then, so we're going to close up the ham boogie, and we don't need this. So now we've got the, the more detailed information. Let's go with a range from, let's go 0101 to, let's go 4 to 123125. That's where the detail is, I believe. So now it's giving us the fountain, and it's giving us the activity that has happened within the increases and decreases, inventory adjustment, check form increasing, invoices decreasing. Those are the sales forms, and so on and so forth. But it doesn't give us a nice total down below. And the reason it can't really do that is because it's not giving us a beginning balance. It's not a timing account. So it's not like it could start at 0 and then give us like the activity for a time period. So report can give you some more detail of what is happening by inventory unit, as opposed to the general ledger report transaction detail, which gives you more information by date. So that's going to be the general idea. So make sure you check your inventory. So one time I had inventory, it was like bowls, and I dropped the bowl and I tried to catch it, seeing it was going to shatter on the ground, but I couldn't do it. Why? Because it was unstoppable. The bowl was unstoppable. It was unstoppable. It's kind of like the Super Bowl. The Super Bowl is unstoppable. It's just going to go, it's going to happen. And there's nothing you can do about it, man. It's a bowl that once the momentum's happening with that bowl, you ain't getting in the way. It's unstoppable.